Hey folks, it's Dave Burrows. I am Chairman and Chief Investment Officer here at Barometer Capital Management. I want to thank everybody for jumping on with us today. It is Tuesday afternoon. We get to do a Barometer Readings webcast. Goal here is to kind of look at the world as it is unfolding, take new information from the week, and discuss, how that's impacting our view of the world and what's happening in portfolios. I can't believe it's the end of summer. Labor Day weekend's coming at us. I'll be interested at the end. I got a couple of quick questions for you. I'm interested in your thoughts as to how you feel about markets and about how you feel things are going. But as always, I want to start from the top because we're coming into an important time of year. And I think that there's some clues that we can pick up on what's been going on over the last few weeks and how the market is handling news, because at the end of the day, the market is a great synthesizer. All the information goes in and price behavior comes out. And I think that the smartest analyst is the market. So with that, I'm going to share some pictures with you today. So let's just go from the top here. We picked the long-term view. And as we have been saying for a long time, we're in a structural bull market in stocks. This is the S&P 500. The S&P now is up about 1.7% in the month of August. You can see August, July, June, and May, 4 months in a row, market's been working its way higher. Seasonally, it should be strong into summer, but very often August and September are difficult months. And here we are towards the end of August, and market has actually been remarkably resilient. We did have some clues when you come into August with a decent trend in place. It tends to be that August and September wind up being better than average. Of course, we always keep in mind the calendar. And when we look at 2-week periods, we can see of all the 2-week periods of the year, first half of August is one of the weakest. Second half of September is one of the weakest. First half of September, again, one of the weakest. So we keep that in mind. If you look at the months, month of September tends to be the weakest month. But then things get better, and generally, and we've seen this very often, partway through October, market starts to lift, rallies through November and December, and finishes the year pretty strong. Well, frankly, the S&P seems to be in decent shape. We've talked about the fact that the trend has been higher. We've seen a series of higher highs and higher lows, and that has been consistent. But Thursday and Friday, we had two very interesting days. Friday, from Jackson Hole, Fed Chair Powell really changed his stance, perhaps bowing to pressure. Perhaps he's just bowing to the pressure of the evidence in the employment markets. But he did recognize that there were risks to employment and risks that numbers undershoot. He felt that the inflation data was getting close to what he was looking for. And signaled that it was likely time for a policy change. So we would expect a rate cut to come in the month of September, and certainly the markets were buoyed by that. You could see a sharp pickup in the percent of stocks trading above their 200-day moving average over the course of the last week. Now, of course, this comes against a backdrop where I think in general investors are pretty cautious. So for the AAII Investor Confidence Survey, which definitely skews to older investors, this is an old measure, we can see that there's been a pretty significant pickup in bearish investors, and bullish investors have been pulling in their horns since June. But that being said, the numbers we saw on Friday were pretty remarkable. So Friday was a 90-90 up day, meaning 90% of the volume on the NYSE was up, and 90% of all stocks were higher. That doesn't happen all that often, but we have been seeing more big breadth days recently. If you take all the times when that happened, where you had greater than 90% of stocks advancing and greater than 90% of volume being up volume, people reaching up to buy, 1 month out, on average, the market was up 5.3%. Now, there's two big outliers here. We have October of 2008, and we have May of 2010. To be clear, both these dates were very different than the date we're operating in. In both cases, the market was in a pretty established downtrend, and there was a counter trend rally. Well, as we've highlighted, in the US market has been in an uptrend. The breadth wasn't great through the early part of August, but market in an uptrend. When you take the other occurrences, all solidly green 1 month out, basically 76% occurrences positive 3 months out, an average up 11%. 6 months out, up 16%, up 83% of the time. And 12 months out, up 91% of the time, an average 23%. So, 2007 and 2008, well, that's a very different period than what we're in right now. So in general, it looked like the numbers were pretty good going forward. So that helped some of the bullish sentiment. Now NASDAQ did not go to make a new high, NASDAQ 100, but certainly some stocks had a great bounce. What was remarkable, though, was that the equally weighted S&P, which we've referenced, had not been able to make a new high, did clearly make a new high last Friday. So we backed and filled on Monday and Tuesday. That's just fine. But in general, I take that as a positive this week over last week. The other thing that I take as a positive is the Russell 2000 far outperformed the rest of the market. On Friday, the Russell 2000 was up just about 5%, which obviously is a very big day. It took out the highs from the early part of this year. Still has not made a new all-time high. But again, that's a positive step. When we look internally, the percent of stocks making a 20-day high was just about 40%. We like to see these spikes in new 20-day highs because it tends to happen as markets are headed higher. We also had the best breadth skew, meaning number of stocks up versus the number of stocks down, that we've seen in some time. 14 stocks up for every 1 stock down. If we look at the other occasions when this took place, again, tends to happen during uptrends and early in uptrends. Now, when we look outside of North America, the developed world ex-US continues to perform well. This ETF up sharply in the month of August, actually outperforming US markets. The MSCI Eurozone ETF, a solid month higher. Japan's market solidly higher, but again, still very early days relative to the 33-year bear market since we made new highs. The last bull market went on for a long time, and the market was up just about 3,000% by the time it was over. So I'm going to put this in the early bull market camp. When we look at the topic index, which is 1,500 companies in Japan, more small mid-cap, more domestically focused, again, very sharply higher. We look at Singapore and other parts of Asia. This is relative strength versus the S&P 500. So Singapore has been relatively outperforming since June of 2024, about 14 months, and no sign of that abating at this time. So we're seeing some great performance out of global markets. If you pull the lens back, again, this is that most recent period. It's the beginning of something, not the end. So new bull market going on to Singapore. Even Shanghai this week made a new 3-year high, and 53% of companies on the Shanghai 300 made 20-day highs. Again, tends to happen early in a new rally. So lots going on. It's Latin America. Peru's up 9.4% so far in the month of August. A solid advance. Now, the makeup of the index here is a lot of basic materials, copper and gold. Both have had an excellent month. And the TSX is up almost 4% on the month. So all of the cohort in global developed markets are strong, and EM has been strong as well. Now, what's helping? Well, financials everywhere. This is the equally weighted basket of banks in Canada. So you can see today up 1.7% on the back of some earnings results. Again, nice relative strength versus the S&P 500. And this has really been the same around the world because we've got global markets solidly in uptrends, and most of them only started in the last year. So MSCI versus the equally weighted S&P, after 3 months of consolidation, looks to be resuming its uptrend, and certainly the TSX resuming its relative uptrend versus the S&P. So these are things we like to see. So we're going to get corrections from time to time. We highlighted some of the breadth data last week. And while the NYSE bullish percent is not quite turned higher yet, Canadian bullish percent, or the percent of stocks in uptrends, solidly positive. Global bullish percent, solidly positive. And even in the US, the shorter term indicators, the percent of stocks above the 50-day moving average, percent of stocks with positive weekly momentum or upward trajectory, percent of stocks making new highs versus new lows, and the percent of stocks trading above the 150-day or 30-week moving average, all have been improving. So that's pretty good going into the month of September. When we look at how things are going, 2 years ago, we felt that it was likely we were going to see a lift in global markets. We took one of our funds, converted it to a global equity fund, 80 companies, 40 value companies, 40 high relative strength, and built a basket. And since we began, equal weight S&P is up 27%. The MSCI All World ex-US Index up 37%. And the Barometer Global Fund is really working. It's just about 50% over the period. So we think it's early days, and that's why we've been building it out as an important holding in the portfolios across the firm. Now, on the fixed income side, things just aren't really changing. This is around the time where it tends to be in an inflationary cycle. We start to get a second wave, and we highlighted last week that both CPI and PPI are showing a little added warmth. We had the Jackson Hole Summit last week. And while Powell signaled that he was ready to change policy and more likely to ease short-term interest rates, the longer end of the bond market did not respond. In fact, yields went higher last week in the long end of the bond market. So that's not great if you're a bond investor. If you've been waiting for the Fed to cut rates, hoping that was going to spur demand in bonds, it's just not happening. 30-year yields are going higher in Germany, in the UK. This is across the curve in Japan, 30-year bonds and 40-year bonds especially steepening. And that means we continue to be in a bond bear market. So what does that mean? The market is telling us that disinflation is not the problem. And that's what bonds protect you against. Fixed income protects you against the risk of falling rates. On the other side, commodities are marching higher. It tells you that investors are buying themselves protection against inflation. So the USCI is a basket of commodities. And this is the very long-term chart. Bull market started in 2020. We went through the global tightening cycle around the world, and the rest of the world started cutting earlier. But solidly, month by month, commodity prices are moving higher, and you can especially see it in the price of gold. After 19 weeks of consolidation, it looks as though gold is resuming its uptrend. And, this is with gold miners really by far the best performing group in the market year to date. But investors are still not on board. So as of a week ago, 41% of investment managers have a 0% weight. 20% of managers have a 2% weight. 14% of managers have a 4% weight. Only 8% of managers have a 7% weight. Now, we would be above this. And we're not gold bugs, but we do recognize that this is an excellent hedge against risks that we currently face in the market. On crude oil continues to be sloppy, and US dollar continues to be weak. So we prefer equities, we prefer commodities. We do not favor fixed income. And in a world where the US dollar is weakening and global stocks are outperforming, we think there is a significant likelihood that we're going to see global investors slowly move money from their most crowded position, which is in large cap US growth stocks, and spread it out globally in developed and emerging markets. A weaker dollar or stronger local currencies incense that behavior. So now we don't have to be everywhere, right? Our job is to find leadership. We think that these are important, big structural shifts that are taking place in the market. We're always watching for change. And in the absence of leadership, we're happy to sit on cash. But, the thing is, there are clear leadership themes in this market. The big picture is we think that 70% of return comes from being in the right neighborhood, right asset class, and the right sectors, and the right parts of the market that are seeing net inflows. And of all of the neighborhoods that we focus on, we're trying to find those that are showing expanding breadth. So where we can find over time more and more securities performing well, it means money's getting put to work. That's healthy. And there's no bear markets that take place when that's the case. When we see breadth deteriorate, is when we get more cautious. Now, from a bottom-up perspective, our job is to find securities to use to express our view in those sectors and themes that are seeing money flow in. And what we're looking for here are the highest quality securities we can find, strong balance sheets and income statements, and where price for those securities is doing what we would expect given what we think we know. Strong fundamentals, strong technicals. And we only need a handful, 20 to 30 securities, build a portfolio, 2 to 5% weights. Where we can find securities that meet our business tests, good, getting better, in areas of the market that are seeing net inflows, that's where our portfolio should live. And then we spend a lot of time watching for sectors or themes where the leadership is narrowing, where fewer and fewer stocks are doing well. And when that takes place, well, that tells us to be a little more cautious, raise a bit of cash, tighten up the stop losses that we use on our positions. In the absence of leadership, sit on some cash, stop putting on new positions. So for quite some time now, breadth, or the bullish percent for global equities, has been improving. And the percent of stocks marked out here on the y-axis has slowly been expanding. In fact, breadth as it is today is better than it has been since 2021. More stocks and uptrends. That's healthy. In the US, we've had a nice bounce off the lows in April, where only 18% of stocks were in uptrends. We rallied all the way through April, May, June, July, but we corrected in August, and it has not yet reversed back up. Very close, but has not reversed back up. So our focus has been more Canada and global for new positions. So let's talk about leadership. So for a long time now, financials have really been leading the global markets. If we look at what's happening in the bond market, the spread in rates between a 2-year bond and a 30-year bond has been widening. So if we see short-term rates move lower and long-term rates move higher, that's expanding the spread that a lender can make lending money, paying a lower rate on deposits and charging a higher rate on loans. It tends to be strong for financial services. And financial services like this condition. Relative to the equal weight S&P, relative strength has been solid for months, and we're just making new highs. The percent of stocks in banks, 100% of them are trading above their 50-day moving average. That tells you it is a broad-based rally. On the other end of the spectrum, there are some groups that have a very small percent of stocks trading above their 50-day, notably software and services, only 25% of stocks, which have been lagging. So the capital markets banks have been leading. Relative strength has been improving steadily since last summer. The group, the ETF that holds this group of securities, Goldman Sachs, Morgan Stanley, Charles Schwab, so on, is trading better than 82% of companies in the S&P, and the relative strength line is rising. Our focus here has been in companies like Morgan Stanley and JP Morgan, which have been sort of top choices of ours for quite some time. Banco Santander is one that we added several months ago. And in fact, the global banks are even performing better. So things going quite well here. Now today, BMO here in Canada had a great day. It was up 4.18%. You can see you don't get moves like that very often. Relative strength has been improving. So I've asked Amit Joshi to jump on today and talk a little bit about what happened in particular with BMO, but what we're expecting from the rest of the Canadian banks.
Thanks, Dave. Appreciate it. Yeah, really good result from BMO for their earnings results today. Like you mentioned, stock up almost 5%. You don't see that very often for Canadian banks. Just to give listeners a bit of context, we initiated a position in Bank of Montreal back in early May after avoiding the name for much of 2024. We felt at that point from our conversations with sell side analysts as well as management that they were getting past their credit issues in their US commercial lending business. And the Q2 results showed progress on that. And then as we got the results today for Q3, those that thesis was reaffirmed. So we did get adjusted EPS that the bank put out that beat consensus estimates by about 9%. This was driven upon better than expected loan loss provisions, so the amount of funds that are set aside for bad loans, as well as strength in the U.S. banking division for Bank of Montreal. So overall, really good result on credit, as well as the U.S. banking business itself. In terms of capital ratios, very well capitalized for Bank of Montreal. Capital markets was okay. Wealth management was very strong for Bank of Montreal. So overall, really good results in U.S. P&C banking and capital markets and wealth. Canadian banking was a bit softer. That's a trend that we think we'll see across the board for all the remaining banks to report. We have exposure to both Royal and National Bank as well. The read-throughs overall, I think for both those banks seem pretty positive. We like Royal as it's one of the most diversified banks in the group itself, has exposure to all the business lines, the U.S., strong capital markets business. And from the results we saw from Scotia today, their capital markets business was actually pretty strong. So that's a good read through for Royal as well. And Royal actually has an outsized exposure to wealth management, which from BMO we saw was very strong. So we expect a good result from Royal's wealth platform as well. In terms of national, they punch above their weight when it comes to capital markets, and we've seen some strength from the banks that have reported so far from the capital markets front. So that's a positive for National Bank as well. And they're in the process of digesting an acquisition that they did of Canadian Western Bank, which has expanded their presence in Canada. That should help with loan growth. We'll want to keep an eye on that just to see if there's any weakness overall in terms of Canadian banking. But I think the key takeaways that we've had so far is the credit quality is coming in better than expected, especially given what we've seen with tariffs and everything else. So the credit picture looks good, even though loan losses are coming in better than expected, and even though loan growth is a bit tepid, the banks are generating a good amount of capital and are returning that to shareholders through dividend growth and buybacks. Bank of Montreal this morning announced a buyback of about 30 million shares that they're going to kick off in early September. So return of capital theme stays very strong for the Canadian banks.
So, Amit, just on that estimate for this year is $11.47, which is what 20% earnings growth. For 26, I think it's 14% growth at this point, or $13. The 4.2% dividend is like $6.50 dividend, so it's about a 50% payout. Do you think that we may see a dividend increase at some point later in the year?
Yeah, I think so. I think the banks have generally been pretty good about increasing their dividends along with earnings growth. They generally follow a schedule. Each of them has a certain quarter that they will raise their dividends on, and we've seen that for each of the banks, and for Bank of Montreal, Royal, National, all the banks that we hold in our portfolios, we'd expect that dividend growth to continue.
Right. Well, one of the key reasons we got these financials on the books, they are generating lots of cash. Thanks so much, Amit.
No problem.
So moving on, industrials, over the last 3 months, basically flat relative strength. They've been performing well. It's a mixed group. Transports have been weak. We sort of stayed away from transports. The aerospace and defense group has been excellent going back to January. And of course, we saw today we broke out of the range we've been in since the early part of June for the group. So that's a real positive. Moving on to materials, what can I say? These gold producers really are on a tear. This is the last several weeks. One of the things that I would highlight is that the gold producers have started to outperform the metal itself after lagging for quite some time. So whether we're looking at the senior gold producers or the junior gold producers, there's really strong evidence across the board. Agnico Eagle, probably our biggest position, relative strength has just been ramping higher over the last 2 years. It was up 1.8% today. Kinross up 1.9% today. This is all the while gold was consolidating sideways. The gold producers reported their cash flow data. The difference between their costs and what they're realizing in the market was much better than the street expected. So whether it was the seniors or the intermediates, we had a question last week on Alamos Gold, and we talked about the fact that it had been consolidating and likely in the back half of the year to be stronger. Well, this is the last 5 days. Stocks moved from 36 to $40, and looks like it's certainly in gear. And it's great to see if we compare the returns of the gold producers relative to gold itself, really only started to outperform early in the month of August. So I would say we're still relatively early in this bull market. And if you look at it through the eyes of investors, this is a chart of the GDX ETF, Gold Senior Gold Producers ETF. And these are flows into or out of the ETF over the last 2 years. And look how much money came out as people maybe didn't believe that this was something sustainable. Only in the last 3-4 weeks have we started to see a little bit more sustained buying. And this is going to look very different late in the bull market. You'll see a lot of buying. So I think there's lots of room to move there. Copper producers having a great month up. So the copper producers ETFs up 13% in the month of August. Again, much better performance than copper itself. And we talked about Hudbay last week. Hudbay announced financing for one of their big developments down in Arizona. It spiked higher. We consolidated for a few days, and look, we're marching higher from there. So I think early days in a new lift for Hudbay. So metals and mining as a group really coming out of a 12-14 year bear market, and this is just the beginning. Uranium producers look very similar. So these are groups that have been leadership. Communication services, which is a bit of a broad basket, but includes Meta and Alphabet and Netflix, Electronic Arts. We own Meta and Alphabet, Netflix, and Electronic Arts. Relative strength for the overall group has been about flat. Meta has been outperforming nicely. Certainly reported good numbers. Alphabet, again, excellent numbers. And I got James Callahan with me just to talk a little bit about what we can read through from what we got from these guys as to how we can look at NVIDIA's earnings coming tomorrow. James, what are your thoughts?
Thanks, Davey. I'm happy to join. Plenty of read-throughs from the other mega cap tech names for NVIDIA, NVIDIA's upcoming earnings tomorrow after the close. NVIDIA's been one that we've been on top of for a very long time, since back when the gaming segment used to be the one that moved the needle. It's really not the case anymore. And every NVIDIA report for the last 3 years has felt very consequential for markets. This one's no different. The option market this time implies a plus or minus 5% move post earnings, which is a pretty narrow range relative to history for them. The last few quarters have been outside of an 8% move. And a lot is known going into this quarter, so we're not expecting major surprises, but now representing an 8% weight in the S&P from a market cap perspective and 4% of overall S&P 500 net income. The numbers matter a lot. So from the quarter specifically, analysts are expecting continued strong growth, of course. Revenue growth of 54% year over year is expected alongside EPS growth of just under 50%. They should deliver just under $24 billion in free cash flow on the quarter. In reality, that's a number that they always beat. So realistically, you could expect them to deliver over $25 billion in free cash flow, which actually this quarter is going to be higher than Microsoft. So a good marker for them. The company's grown into a behemoth. It's not just a revenue grower; they grow incredibly profitably. As you can see, this is a table from NVIDIA's annual meeting. Uh, they maintain a very solid margin profile. So in fiscal year 2025 for them, they reported gross margins of 75%, and that's up from just under 73% the previous year. This quarter, margins probably come in around 73%. They've had to spend a bit more to support the rollout of their GB300 data center stack, which is a mid-cycle refresh of their top-tier AI GPU offering. So it's likely we get some more info on China revenues. That's been a focus from a geopolitical standpoint. The Trump administration, obviously during the quarter, greenlit deliveries of the NVIDIA China market specific GPU, the H20, after previously banning exports. So that issue's been a bit of a hot potato, and will be going forward. It's not clear what the final outcome will be, but NVIDIA stopped producing the chip. They have them warehoused, so the extent to which these chips sell is all incremental revenue and is all inventory that's been written down in prior quarters. So it's hard to know how much they can sell. I've heard the expected range is between 10 and $15 billion of H20 sales for the rest of the year. That's not much considering that Nvidia is going to do over $200 billion in revenue this year. But the focus will be on forward outlook, and we do have some good color on that. Nvidia customers, for example, during their reports, just some excerpts there. So Amazon reported that in the GPU market, they're seeing their own demand vastly outstrip capacity, which is a good environment for NVIDIA. That means tight supply environment. So they're selling all the GPUs that they can produce and more. Google noted that their usage of GPUs has doubled over the last year, and they raised their CapEx outlook for 2025 to $85 billion, so a massive number. Meta as well, they expect another huge CapEx year next year. They're still not fully meeting demand, and they're still seeing compute resources constrained. Microsoft, same thing as Amazon. Demand is outstripping supply, and the same as CoreWeave, which is another massive customer of NVIDIA. They see a massive workload increase for them. They have a vastly expanding footprint, and they're seeing demand outstrip supply. So really good commentary from the customers. I don't expect any major surprises after the close on Wednesday, so we remain long. We still like the AI trade and the AI infrastructure trade, the AI power development trade. It's long in the tooth here as we've been involved in this name, on and off over the course of the last 2 3/4, kind of 3 years. But we've made some really good money in client accounts owning it, and we've owned it well over the last 3 years, and so we expect to continue to do so. But it should be good numbers on Wednesday.
And James, just quickly on the defensibility of their franchise, their offering just continues to get more and more integrated, doesn't it? Could you talk a little about that a little bit?
Yeah, that's right. I mean, throughout the development of the more recent GPU generations, it had always been discussed, especially among investors. NVIDIA is doing the best at training the AI systems, but when it comes to inference, maybe other companies' product offerings will be better for inference. AMD was the company that was widely discussed as kind of taking the torch from NVIDIA when workloads moved from training AI systems to actually running the AI systems doing inference. And we've seen that absolutely not be the case. NVIDIA has such an advantage over any competitor that their inference performance is so much better that they can charge much higher prices for their products, and they can continue to sell the leading edge GPUs into inference workloads just because when you look at the amount of product you would have to buy from a competitor in order to compete with, for example, the GB300, which I included a picture here. You don't often see pictures of these GPU stacks. I know I'm guilty of this. You kind of think of them as these ephemeral things, but this is actually what they look like. And yeah, you can get so much out of a single GB300 that it's worth the cost, vastly worth the cost.
Interesting. Great. Well, thanks very much. Well, we'll stay tuned and see what comes tomorrow. But certainly the foreshadowing from a lot of their customers has been pretty strong coming in. Moving on, energy, energy continues to be very mixed. This is the equally weighted oil and gas producers index here in Canada. The beginning of this consolidation was December 2024. You can see the index has been unable to make a new high, did have that big dip in April. This is a group that we took our exposure down from about 12% to 6% to a couple of months ago. The producers index in the US has had even weaker relative strength. And it's not to say there isn't a case to be made for the fact that in a more inflationary environment, we would be likely to see stronger energy prices, but we're not seeing it yet in crude. We're not seeing it yet in the producers. And again, this is where we just try and stay with our discipline. You know, Imperial Oil would be our biggest position, and boy, doesn't that look different. You know, this is a company with a very low cost of production, generating a ton of cash, and relative strength has been steadily improving since March of this year. We're basically, you know, at all-time highs. So when I pull the lens back and say, where does it look like we are in the big cycle? You know, we've only just come out of a bear market that started in 2008. And the last bull market, you know, gave a 775% return once it came out and made new highs. So at a 2.4% dividend that's growing at greater than 20% a year, and very significant buyback program. We think this one is a good one, and certainly CNQ fits the same bill. So a lot of the same groups continue to lead. Is there sign that the economy is slowing and that investors are getting more defensive? Well, we look at the defensive sectors, consumer staples, just nothing happening here. Relative strength, new lows today. Healthcare certainly had a nice bounce when the news about Warren Buffett's purchase of United Healthcare came out. But relative strength still in a sizable downtrend, still trading below the 50-day moving average and the 200-day moving average. REITs continue to underperform. Well, they get hurt by higher interest rates, so that makes some sense. And utilities, despite the demand for power and despite a decent looking bar chart, the relative strength continues to be weak. So not so much changing. Now, people ask, our partner Greg retired in March of 2023. It's now been about 18 months. And, you know, how are things going? Well, since March of 23, our equally weighted S&P in Canadian dollars up 41%. Our equity portfolio is up 50.5. So about 10% outperformance here. The aggregate bond index is up about 9% over that period. The dividend aristocrats ETF in the S&P is up 26. Our tactical income fund is up 42. So I'm really pleased. You can hear the expertise in James's voice and in Amit's voice, Brian McNichol, who's on from time to time. The team is working really, really well together. As far as sector leadership goes, at the beginning of August, you can see the average sector had 45% of stocks in uptrends, a lot of sectors in small letters, and that was sort of some of that weaker breadth that we talked about. Really, breadth has gotten a lot better. Percent of stocks in uptrends now 48%. A number of groups back into capital letters, especially importantly the banks. So when we come to positioning, there's not a ton changing. You know, financials continue to be our biggest weight, and that makes sense. From a month ago, we got slightly less weight because, as you know, we took some profits in insurance just because it had become a very large weight due to the strength. Industrials about the same as we were a month ago. Technology about the same as where we were a month ago. Materials have come up, but that's frankly just relative performance. Communications basically in line with the S&P index. And when we go down the list, you can see energy now 7% versus 14. We'll see if energy can wake up here in the fall. We'll watch for that. We've got about a 5% cash weight. As I said, we like to have a little bit of cash going into fall. Consumer discretionary is a low weight, and even consumer discretionary is a funny way to put it. I mean, our big weights are in Loblaws and Dollarama, two pretty conservative holdings, but both behaving extremely well. Consumer staples a significant underweight, healthcare a significant underweight, utilities a significant underweight, real estate is significant underweight, and bonds are basically a zero weight, other than what we have to have in our balanced portfolio. So look, we're watching for signs of risk. We're aware of the calendar. The bond market is telling us that credit risk is as good as it's been going back to 2007. So the excess demand being demanded by bond investors who are naturally risk averse is that they are comfortable with taking credit risk both for investment grade and high yield bonds. The measure of volatility, VIX, where we sit today, is solidly in the middle of the average range for volatility during structural bull markets. So no sign of major risk here. You know, in the early part of April, we had a big lift off the bottom. And we compared it to other periods where the market had a quick rally off a low, and what things looked like 6 months out, 1 year out, 2 years out, 3 years out. And despite being pretty nervous about what was happening geopolitically, you know, here we are now, May, June, July, August, 4 months out, 4 of 6. And the S&P is up 27% off that April 4th low. So things look decent. You know, we are in a bull market. We're solidly above that rising 200-week moving average. We are watching for signs of risk, but breadth is getting better. Some of the leading stocks are getting better. We are not seeing weakness in our key leadership groups. And if we do, you know, we'll get more defensive. But I think one of the things that can hurt you the most is following how you feel about the environment as opposed to using the real evidence. And so all we can do is use our processes to make our decisions and be iterative in the portfolios. And I think that we're in a decent spot. So with that, I'm going to see if we got any questions here. First question I have is from from Greg. And Greg is asking about, let's see if I can pull my screen up here. Here we go. Share this. Is asking about Dollarama. Dollarama stock appears to be one that is good, getting better. Do you have a view? And so as I mentioned earlier, actually Dollarama is one of our biggest positions. We've had it for a very long time. You can see it's had strong relative price performance. It has steadily beaten estimates. Estimate for 2027 is $5.26. Estimate for 2026, $4.65, up 11%. This has basically been steady as it goes, very well executed, and it's a position that I don't see us leaving unless we got a significant technical change in the stock. I've got a question from Jay on XRP. You know, we do have some Bitcoin and Bitcoins in a long-term bull market. Aside from that, we haven't focused a lot. We have a small position in Ether in our macro portfolio. Macro portfolio is up about 9.5% on the year and is focused mostly in materials, precious metals, copper, and global stocks, but does have a position in weak US dollar assets, which would include Bitcoin and Ether. Anonymous, do you believe there's a strong case for higher inflation given we've seen some weaker data in employment, consumer spending? I think we have yet to see the impact of tariffs. I think that has an impact. I think services inflation, which is housing, has been sticky. And both PPI and CPI came in a little hotter than expected. So we're going to have to see over the next couple of months. But the way the bond market is behaving, the long end of the bond market, when people are putting money out for 30 years, they think hard about the impact of inflation. And they've been demanding higher yields. So I think that if I take all of the instances of inflationary cycles in the past, after a first moderation, there's a second wave, and there's some indication that that may be coming. And I'm thinking that that's probably why Powell has been very hesitant to become easier with policy. But I think the political pressure is pretty heavy. Jerry's asking, given the last report, the gold producers showed massive difference in costs and what they sell a product for. Do current multiples reflect that? Or do investors still not believe they can continue the great earnings? Look, clearly there was a disconnect coming into the quarter, and the stocks are, you know, squeezing out some of that excess. But I think it's early days. There's no evidence that the price of gold is reversing direction. I think it's still relatively underowned. It's been central banks largely that have been the buyers, not individual investors or institutions. If you consider the very low weight that investors have in gold producers in their portfolios, I felt we were taking a lot of reputational risk when we built our positions in the first place because people were so negative about gold producers. I think that there's lots of room for expanded ownership. There's very little speculation in the group so far. And the third thing is with oil prices staying weak, I mean, energy is their biggest input cost. So it looks like their cash flow yields are going to remain very strong. So we think that they do have a pretty long runway. And then Jim asks, Dave, do you see a scenario where North America follows the European model on currency security and immigration? I have to say, it feels as though everywhere in the world, the pendulum is starting to swing a little from the left to the right. I think immigration policies in general are getting a little bit more stringent. I think security seems to be getting a little bit more important. Defense spending is picking up everywhere. We may not like the way that it's happened, but I think that the US administration policies are basically saying, okay, you guys all have to stand on your own feet and compete like the rest of us. So we're seeing tariff barriers come down. So I think actually Europe and Canada are moving a little more to the right, and that's probably not a terrible thing for markets and for business. I think that's it. Okay. Certainly we really appreciate you guys jumping on. I've got a quick poll I'd love to put up for you. See if I can find it now on my screen now that I'm saying that. And I'm not. I gotta really have to be better with technology. Okay, we're gonna have to ask these the next time. All right, everybody, thanks for joining. If you've got questions we haven't answered, please. Oh, here we go. I'm gonna put this up. First of all, I'm really interested to know what your outlook is over the next few weeks, whether you're bullish or bearish. And the second was if anybody'd like to have a conversation, please let us know. I'm going to put these up now. Thanks very much, everybody.